All right, Jedi Options. Today's discussion, an oldie but a goodie. This is a common decision that traders face with deciding, do you do directional versus theta or cash flow. So let me tee up the pattern first, and then I'll kind of walk through strategy selection, right? So Amgen, Matt teed this up earlier in the halftime report. Really decent response to earnings. Here's actually what I like about it. Amgen was on my radar yesterday because of this little breakout. I actually thought it had earnings yesterday, and I had teed up an article writing about Amgen, and then I'm like, wait a second, they haven't even reported earnings because the earnings was last night. So it was impressive to me once I found that out, first of all, that it broke out ahead of the announcement. Now, last night, the initial reaction was negative. It gapped down. It opened lower this morning, but they bought it up again. So I like how the open this morning tested the old resistance zone, and then it popped, right? So I feel like they're just reminding us, hey, no, we broke out yesterday. Like we meant it. Today we got tested and we held that support zone. So I like the action. I like the ascending triangle pattern here. You know, if you look 3 weeks ago, Amgen looks like garbage, right? You've seen a very nice turnaround in the stock here. So I'm encouraged. I think that if this positive earnings momentum continues, maybe Amgen makes a run back up, hopefully towards the 200-day moving average. But it doesn't even need to make money on the trades that I'm gonna give you today. From a trigger perspective, 220 is a pretty significant zone. Old resistance, old support becoming new resistance. If you want further confirmation, I think a break above 220 could be an obvious trigger point. So the question is, by the way, I think someone also might have triggered in today when it broke above yesterday's high. So your choice on the trigger. But the more important question in the topic today is, what strategy do I use to capitalize on this Amgen reversal? And fundamentally, I'm going to draw a picture here. I was thinking about this throughout the discussion today. Yeah. I think a great way of categorizing or understanding the difference between a cash flow play and a more directional play, specifically a bull call versus bull put. So think about, and we've done Jedi Option segments on this, there's a trade-off between the risk in the trade, the reward in the trade, and the likelihood that you actually get that reward, right? The probability of profit. And in general, when you do a directional trade, you're usually risking less. Okay, so let's say the risk is low, the reward is high, but the probability of profit is typically lower. Okay, and then when I'm doing more of a cash flow play, the probability of profit's higher. Well, look, you don't get something for nothing, right? Wall Street is a world of trade-offs. If you have a high probability of making money, you're not going to make that much. So the accompanying reward is lower, and the dollars at risk are higher. So when I look at the Amgen chart, the directional trade we're going to look at is going to be a bull call. This is a vertical spread, and the cash flow play is going to be a bull put, which is a vertical spread. So birds of a like feather here, both vertical spreads, one's directional, one's more cash flow oriented. Here's the way that I would visualize this, right? The chart shows we're at like 216. Okay, so I got a stock sitting at 216 bucks. With a cash flow play, I'm going to build a strategy where I make money even if the stock just goes sideways. And so the bull put, I'm going to do a December. Let's actually keep the color here. I'm going to do a December 200, 195 bull put. I think right now it's around 60 cents. Okay, 60 cents. So think about that visually with the chart. I'm selling a put at 200. I'm buying a 195 put. Okay, so it's a $5 spread. So you got 200 and you got 195. Now, the risk, if I get 60 cents, I'm risking $4.40. So if you visualize the distance between these two lines as the spread value or the potential, risk versus reward, the lion's share of that, $4.40 is risk potential. And then the smaller portion is the potential profit, just the 60 cents. So risking a lot to make a little, but the probability, I don't know off the top of my head, let's say the probability is like 85%, like an 85% probability of profit. That's one way you could play this trade. Or Amgen, you could say, look, I'll risk a lot to make a little with a high probability. If Amgen goes sideways, I win. If it goes up, I win. If it goes down a little bit, I win. It just can't go below 200, right? I think that when you look at the chart of Amgen, I think that's a decent bet. Like $200 is support. If this earnings optimism really does carry the day and carry the month, this thing shouldn't go down to $200, right? I think that's a decent bet. If I go structure that trade and I go to December, which is 44 days out, which I think is a great time frame, I sell the 200, I buy the 195. It's actually 72 cents. I had said 60. I guess wrong. It's 72 cents. So my risk is 428 to make 72 cents. Still risking a lot to make a little, but my probability, I'm selling about a 19 delta actually. So my probability of profit's around 81%. Okay, I think that's a legit way of playing Amgen. But you may say, hey, I don't really like, that route. I don't like the high probability, lower reward route. I'm going to go for the gusto on this. Well, you could do the bull call, and maybe you buy the 220 call and you sell the 225. Again, $5 spread here, so it's apples to apples. That is not going to cost you that much money. It's a cheaper trade. Okay. Again, I would stick with December here. 220 is basically the first strike out of the money. Buy that, sell the 225. It only costs you $1.50. So if you look at the risk versus reward, I'm paying $1.50, which is just a little bit, right? This amount of this gap area, paying $1.50, that's my risk. And I can make $3.50. So the majority of the spread is profit potential. Well, what am I giving up? What's the catch? Risking a little bit to make a lot. Well, the catch is it's got to get up to 225, and the delta is 27. There's about a 27% chance we're going to be above that at expiration. And so your probability of profit, instead of being 80+%, it's about 27%. Okay. Both work. Out of the money bull call, out of the money bull put. Both legitimate ways of playing this. One has lower probability, but more profit potential. The other has higher probability, but less profit potential. And then you just look at the chart and you say, well, if I draw the same kind of lines or boxes, I could do the 200, 195, do this spread here, or I could do the 220, 225 here. And I'll try to get them perfectly symmetrical here. And it's like, what route do you want to take? Which route do you want to take? Both legit. I think they're both fine trades based off of a nice bottoming pattern. One, you're risking a little to make a lot with a low probability. But we say low. I mean, is 225 really that outlandish? No. I mean, it could get there. It's only a couple ATRs away. Or bet it stays above 200. And like I said, have the higher probability route. I like to, in conclusion, I like this as a smart, easy, simplified way of comparing cash flow versus directional and understanding the trade-off with risk, reward, and probability. And then you can make an educated decision. You can make an informed decision. I mean, look, knowing all this doesn't necessarily mean I know what Amgen's going to do and I can predict the future. No, but I can make a much more informed decision, really understand why I made the decision and what the accompanying trade-off is. All right, Matt, come back in. That's Jedi Options.
And Tyler, yet again, a fantastic job. Question I have for you: after you've detailed the bull put and the bear call side of the equation, where do you land on it?
So I'm always, well, two answers. The first default answer is I'm always partial to the credit spreads.
Yeah.
So I'm always partial to a bull put. However, if I have a portfolio that's already chock full of that stuff, I like to mix it up a little bit, have the occasional directional trade. I don't mind this bull call because you don't even need a stop loss. Your risk is so low. So if you think this thing comes around, I don't mind the bull call spread in this situation.